Welcome to episode 4 of the Who is This Loan Officer Person? A Disambiguation. First episode, we talked about types of institutions. We talked about types of lending in the second episode. In the third, we talked about licensing in the MLS. And today, after having buried the lead 3 times in a row, we're going to talk about what a loan officer is. All right, in general, an MLO or mortgage loan officer is a person that originates mortgage loan business, 1 to 4 family mortgage loan business for their institution or themselves. That institution could be a mortgage bank, it could be a regular money center bank like Wells Fargo, etc., or it could be a broker shop as small as 1 person. A national bank mortgage loan officer is a loan officer that's licensed through the registration only with the NMLS. That means they don't have to complete NMLS courses or state level courses. They instead are passing the continuing education courses required by their regulator, and that is the Office of the Comptroller of Currency and or the FDIC, etc. Now, the only difference between the licensing of a state level loan officer and the licensing of a national bank level loan officer is that the state level loan officer has to get their license in advance of originating business, whereas the national bank level loan officer only has to complete continuing education based upon who their regulator is. As far as the programs they can offer, they're only able to offer programs that are in their bank's own name. So territory, unless their company says otherwise, these loan officers can originate business in all 50 states without having any additional licensing based upon the requirements of those individual states, because they are working for a federally regulated bank, therefore are not required to participate in any state level regulation. All right, what are the pros and cons for working for a national bank? Well, at a national bank, you can originate anywhere in the United States as long as the bank lends in that state. Some companies don't choose to do mortgage lending in places like New York because the regulatory requirements are too cumbersome. That's just an example. There's no need to participate in the cumbersome NMLS registration process. So they don't need to take continuing education and prove it to the NMLS. They simply are registered through their bank, and their bank is subject to review by the bank's regulators to ensure that the loan officers are properly licensed in that they have the continuing education required. Often national banks are nationally known brands, so if you were to work for Wells Fargo, everybody in the country knows who Wells Fargo is, or Chase, or Citi, or Bank of America. And then they often have internal referral sources. So some loan officers will sit in a national bank and they will get referrals, say, from the tellers who would refer somebody interested in a mortgage over to them. The cons on this are they're limited in programs. They can't reach outside of the box and drag in a program for the odd customer, which other institutions can. Their guidelines are very restrictive. It's going to be based upon what either the GSEs, remember that's government-sponsored entities, or the national bank has in their portfolio programs, and they can't reach outside of that box. They are in the banks are not in the mortgage business. Now, while most, as I discussed previously, while most banks do mortgages and could be considered mortgage banks because they have mortgage operations, most of their income comes from other sources rather than mortgages. And so when it comes to, from a loan officer's perspective, when it comes to focusing on what we do, they're not as inclined to do that as, say, a mortgage bank or a broker. Often the national brands have bad names. So if you are a Wells Fargo customer and you've been fed up with them, or a Bank of America customer and you're fed up with them, you're not going to touch a Wells Fargo or Bank of America loan officer. That said, I must say that there are a lot of good loan officers at both of those institutions. And even if the institution is terrible, a good loan officer can get a good loan through any institution. So along with the mortgage banks maybe having a bad name and they're not being involved in the mortgage business as hardcore as perhaps a mortgage bank or a broker is, This is sort of goes along with the loan officer being subject to the whims of the bank. So if the bank wants to place more emphasis on credit cards or deposits than it does on mortgages, they might back off on mortgage operations staffing or tighten up their mortgage lending requirements, offer fewer exceptions and that kind of thing. And they also have centralized operations. Now, most of us have centralized operations right now because of COVID and everybody working from home. But the thing about centralized operations is that if you're not in there with the same processor every time, whether or not it's centralized, if you're just sitting in a queue waiting for the random processor to pick it up, you can't provide people with a consistent level of service. And if you can't provide a consistent level of service, you can't get referrals. And that's what this business is all about. Finally, the last con that I came up with, I'm sure others exist, and I'm sure other pros exist as well. But the final con is that they're highly restrictive on their systems. You can't reach outside of the box and do some sort of marketing that hasn't been directly approved by their compliance team. While most people do marketing and they remain compliant regardless of what their company says because they want to continue to keep their license, the reality is at one of these banks, you can't take your laptop anywhere. Often you can't solicit your own customers. You can't make your own marketing pieces, even if they are compliant. Sometimes these banks have a process by which top producing loan officers can send their marketing collateral into a compliance team for review. But most of the time, you're just kind of stuck with what they have and the tech they have. And you often can't even get your email on your phone, that kind of thing. All right, so mortgage bank loan officers. So the licensing required here, as we discussed last episode, is state level licensing. And that means you have to be not just registered with the NMLS, you have to be licensed with the NMLS. So you have to take the NMLS required national course, and then you have to take any state required course and then continue with any state required documentation like bonds or errors and omissions insurance. The continuing education required is assigned by both the state and the NMLS, so you have to stay on top of that. I'm doing mine right now, I'm about halfway through it. Got to get it done before December 31st. Programs. So loan officers that work for mortgage banks often have access to a wide variety of programs. Their programs are based upon the relationships that their particular mortgage bank has with individual institutions such as Chase or Citi or NewRez or, as I mentioned earlier, Pentagon Federal Credit Union, etc. So there's a vast array of programs. In addition to the mortgage banking programs, which again are funded in the name of the mortgage bank and then sold directly to the end investor after lien perfection and review. These mortgage banks can also have broker relationships where they are lending in the name of the broker relationship. And finally, territory. Loan officers that work for mortgage banks must be licensed in each individual state that they want to be in. And those licensing require their own individual continuing education. So, if you want to be licensed in a bunch of states, you're going to spend half the year doing continuing education. There are some states that don't require continuing education, but most states do. So it's difficult to be licensed in a whole bunch of states because there's lots of continuing education required. All right, what are the pros and cons of working for a mortgage bank? So you typically have access to a large array of programs. Typically, these are very mortgage-focused institutions, and so something along the order of 97 to 100% of their income comes from mortgages and their satellite businesses. As I discussed earlier, those can be things like escrow or signing services or homeowners insurance kind of thing. You can be part of a nationally known brand like Guaranteed Rate or what I'm trying to do here with Mason McDuffie. Loan officers operate in a largely independent fashion. There's no need to show up into the office like if you worked for Wells Fargo at a banking location. You would probably have to be there a certain number of hours per week. When I was looking at working for Chase, they were requiring you to be in the office 30 hours a week. That works for some people, doesn't work for others, certainly doesn't work for me. And then finally, your typically able to innovate around your production tools and your marketing tools, et cetera, as long as you remain compliant. Oftentimes, mortgage banks have compliance departments where they want to review any marketing collateral that you send out. But as long as you're compliant, you're pretty much in good shape. Now, what are the cons? They're rarely a national brand. So Guaranteed Rate is an exception. Most mortgage banks would be unknown to anybody not in the industry. There's little to no internal referrals. Now, some mortgage banks, like Guaranteed Rate, for example, have programs you can participate in where you pay for leads, but these aren't internally generated leads as such. They're more externally generated that you pay for them, even if Guaranteed Rate, for example, owns the telemarketers generating the leads. They have to abide by correspondent and broker lending contracts, and that can be really painful because if, for example, a customer refinances the loan that you did for them within 6 months, you're going to have to pay that commission back. So I always tell my loan or my folks that I'll start looking for new rates for them within 4 months, and we can lock it out for 60 days and get it closed. But if they must refi, do it with me because at least it'll be a break even for me and it won't take money out of my bank account, which is what happens if the thing gets paid off early. They have to be licensed in every state, like we discussed on the other side. You know, doing all of that continuing education is a pain. That's point number 5. Actually, they have to complete a ton of continuing education. And they're also subject to this like cumbersome esoteric process of NMLS licensing. That's kind of a pain. All right, brokers. What is a broker MLO? Licensing required in every state, just like a mortgage bank. The continuing education, again, like the mortgage bank, is required by the state and the NMLS. The programs they offer can be a wide range of programs. The only caveat being the institution needs to have a wholesale lending team and therefore be able to set up broker relationships. But there's a lot of institutions out there that allow that, and it also allows for very marginal loans. So you have somebody that comes in that's self-employed that doesn't have any income showing, but because they're writing everything off, but they have large deposits in their business account. Oftentimes, a broker relationship will allow you to use bank statement loans, that kind of thing. And then the territory, they are subject to the territory within which they are licensed. Most of the time, that's going to be the individual state where they reside. All right, pros and cons for being a broker. The pros are access to a large array of programs, it's all about mortgage. So in broker shops, whether they're individual or multi-person broker shops, 100% of what they do is mortgage. So they're always focused on, at least they should be always focused on improving the loan officer experience. When you improve the loan officer experience, that's a shorthand way of saying improve the experience of both the realtor and the customer as well. They have very low overheads. Most broker shops don't have operational staff because broker loans are done through, operations is done through the bank that they are going through, their institution that they have the broker relationship or wholesale relationship with. So they don't have a lot of overhead. So because of that, you have maximum ability to innovate around operations and marketing tools. And they're rarely strict on the reporting structure. So loan officers, as long as they're closing a loan occasionally, most broker shops aren't interested in getting rid of people. Whereas if you don't close a loan for 6 months at a place like Wells Fargo, you're gone. And oftentimes at mortgage banks, it's the same way because of the overhead required per seat. In broker shops, it's very low. And so you could be a absolute part-time loan officer and you could work for a broker shop. The cons, again, licensed by state. Many states have additional requirements for brokers and licensure, and such as demonstrating that they have errors and omissions insurance. They get no internal referrals whatsoever because there's no customers other than those that you bring to the table. Many banks don't offer a wholesale lending opportunity. So Bank of America, Wells Fargo, I don't even think Chase does. So these major banks typically don't have wholesale divisions. I think that was because in 2008, they all got hosed, a lot of them by the broker situation. So I'm sure they got hosed by the banking situation and by their internal folks. But the reality is that they decided to cut their losses and therefore don't have any wholesale relationships available for brokers. So again, those programs can be sort of at the margins, but they can be very, very useful. As well as being a pro, having very little internal operational structure is a con because you can't simply pass your file off to a processor and move on to the next deal. You have to work that loan all the way through, and trying to negotiate the operational teams of the end investor or the wholesale relationship can be very difficult at times. There are many banks that have great wholesale operations teams, but a lot of them just, it's first come first serve, and they don't return calls, and it's terrible. So again, having an internal operations is good. Having an internal personalized operation, so you go to the same processor every time, is the best. And I think you find those at mortgage banks. These folks too are subject to the cumbersome NMLS renewal process, and it just is what it is. And regardless of wholesale relationship, you're going to have EPO or early payoff requirements, and they're going to be raking back commissions, and there's no one else to take that hit. So I've worked for all three of these types of institutions. Banks never hit me for any kind of early payoff. I've been hit with mortgage in the mortgage banking business. I've been hit with early payoffs 4 times. Only 1 time did they charge me back for it. I really do try to set those expectations with customers so that that doesn't happen. But in mortgage, in a broker situation, you're just stuck. All right, well, this has been my 4-part series on who is this loan officer person, and we just discussed what a loan officer is and the types of loan officers that exist out there in the ether. My name is Mike Collier. I've got 27 years of experience. I think I said 28 earlier, but it's 27 years of experience as a loan officer, and you can reach me at 650-288-8170. That is my everything number. My email address and website are on this page, so make sure to copy and paste and keep it handy, and let me know if you have any questions whatsoever. Put them in the comments below or email me back. I'd love to help you. Take care.